have to sort of understand and agree on. One is what are homestead school taxes? That's homestead school taxes are taxes on primary residences in Vermont and all the adjacent land. That these are the taxes that the rates that are set locally based on spending per pupil impact. Non-homestead school property taxes is everything else, land, open land, second homes, and business property. The legislature sets one rate statewide for all non-homestead school property taxes. So that's not, they're not directly impacted by the votes at in individual school districts. Per pupil spending is the number or the amount that impacts the local tax rates. So the tax rate in any community, the tax rates are move up and down based on spending per pupil. Higher per pupil spending results in higher tax rates in your community, and lower results in lower tax rates. And I say tax rates because each community sets both an income rate and a property rate based on its spending per pupil. The tax department assigns a rate, and then they're the same for any two towns that have the same per pupil spending. A house site is a subset of a homestead, and it's a house and up to 2 acres. The house site and the house and 2 acres is what is, when people pay based on income, they don't pay the property tax on the house site. They pay instead an income tax, and that's what this bill would do as well. So just kind of, you know, ground the conversation. Let's see, moving ahead here. So quick summary of the school taxes. All school taxes in Vermont are state taxes, and they go into one pot, the state education fund. And so essentially what goes into that pot are homestead taxes, which is we just talked about, non-homestead taxes, which we just talked about, and other taxes. Currently, the main ones are the sales tax, revenue, rooms and meals, 25% of the rooms and meals tax, and then lottery proceeds. And the percentages on the pot there indicate that homestead taxes are about 25% of the fund, non-homestead taxes are about 40%, and other taxes are 35%. So the idea of going to an income-based system is not actually new. We've been talking about this in Vermont for a half a century. In 1970, the state started providing property tax relief that was based on, for Vermonters 65 and older, that was based on their income, so that it provided a rebate to their property taxes based on their income. That was expanded to low-income residents, you know, broadened in 1973. There have been changes over the years, but in 1997, when we passed Act 60, it was more dramatically expanded. And so this gives you a sort of a profile of what things look like. What happened is that this is 1978. You can see it was basically at the number of households, about 20,000, 15 to 20,000 households participating. And then that gradually went up as the program was expanded to about 40,000 in 1997. And then with the passage of Act 60, that went up to nearly 120,000 households could pay some or all of their school taxes based on their homestead, based on their income. So the problem, so you know, somebody, you know, we were talking earlier, and the idea that Vermont has the most progressive system in the country is true, but the rest of the country is, as I was saying earlier, pretty bleak. So it's not an indication that things are fine here. It's more that they're not as bad as every place else. And so there's some real challenges left that this bill seeks to address. One is that the current system is complicated. People are we're generating both an income and a property tax rate for homesteads in each town, and and for people to vote on school budgets and know the tax impact, they have to collect a lot of information that, as a practical matter, no one is collecting. The tax department at one point, I think, estimated that there were 20 pieces of information that a taxpayer needed to collect in order to know that their tax impact. But this lists some of the things that, I won't go over them, but there are some of the things that people would need to know to actually know what the impact was on their tax bill. The problem with that is that we have a direct democracy decision-making process, and that if people need all this information but aren't able to access it, then they're essentially going blind into what the tax implications are, or they just have to believe what people are saying in the room without actually using any critical thinking. It's not a great system for allowing people to understand what's going on with their school taxes and to be able to cast a vote accordingly. The other challenge is that the system is regressive. And what that means is that people with low and moderate incomes pay a higher percentage of their income in school taxes on their homestead than people with upper incomes. And what this is 2017 data. I believe Deb has a chart that's more recent, but it basically shows the same profile. What you have is and so at the bottom you have household incomes that go from 10,000 to 1 million, and then up on the left is the percentage of income that people are paying in the various categories. And what you see is that between, say, $0 and $130,000 of household income, the average tax rate is somewhere between 2.5% and 3%, but then it drops off for people with higher incomes down to as low as 0.5%. So essentially, people in these lower income categories are paying 5 times as a percentage of their income what people that have $1 million are. So that's a problem in terms of fairness in the system and people feeling like the system is treating everybody fairly. So a couple, I don't know if people heard Brave Little State that came out on Thursday, but we were talking about a lot of things in that about an income-based system. But one of the things was that in 1997, when we passed Act 60, the House actually passed an income-based school tax. This is and it had passed it in 1994 as well. So the House has passed twice a bill much like H388. There hasn't been one introduced that I know of since then, so it's been 25 years since we've seen a bill like that. And we would have had that legislation if Howard Dean, the governor at the time, had been willing to sign it. And he was not willing to sign it. And he articulated in this to Peter Hirschfeld in Brave Little State recently. He said 3 reasons, but there's really 2 reasons. One is that the concern that if the tax rates get too high, that rich people will leave the state. And we've documented studies all over the country that have shown that when you have millionaire taxes or taxes on the wealthy or whatever, yes, some people leave, but it's not a significant number and it doesn't detract significantly from the revenues of the state. So it's really, that's not a concern that should keep us from taking a step like this. The other concern that he expressed was that income is more volatile than property as a source of revenue, which has been a common, I'm going to say now, misunderstanding. We actually did some analysis, and the tax commission has also done analysis, which Deb can talk about, that shows that essentially both income and property have about the same level of volatility, that there's really not a big difference between income and property, and that's not a reason to not enact it's not a reason to enact this. So I just wanted to highlight those things. The last point I make is that some people have expressed concern about going about relying too heavily on income for state services. And what this shows is that based on 2018 data, and again, it would be similar, that property reflected about 24% of state services, 24% of the income supporting state services, and income was 32%. If we went to an income-based system like H388 proposes, we would drop from 24 to 20% for property and go from 32 to 36% for income overall for funding state services. So it's not a huge change from a systemic point of view, although it would make a huge difference from a taxpayer point of view. So I think I'll just stop there and pass it over to Deb. I'll stop sharing.
Thank you, Paul.
Okay, ready for me?
Yes.
I'm Deb Brighton, and I was on the Tax Structure Commission, but since then I have been working with the Joint Fiscal Office of the legislature, and I have actually modeled the proposal as closely as I could from H388 and using data from actual people in fiscal year 2020. And so what I really wanted to show was where we're going to get to if we had this bill passed. And so I have some charts. I'm not going to get too much into the weeds of it. Hopefully the charts will sort of tell the story. If I can share my screen then. Can you let me know when you see a screen?
We see it.
Great. Okay. So the first thing that I wanted to point out in this chart is that the school district controls your rate, just as it does now. As Paul said, it's the spending per pupil in your school district that determines the rate in your school district. So although this is a state program, we've maintained local control, and each district will have its own rate. However, their rate doesn't depend on the adjusted gross income in their community. All communities have essentially access to that state pot that Paul showed you the picture of, that has all those different revenues going in. And then they're shared by all districts based on their spending per pupil. Okay, so this is just showing you two districts, District A that spends $15,000 per pupil and District B that spends $17,000 per pupil. And so there are two things that I want to show in the chart. One is that the two districts have different rates depending on the spending per pupil, and that in each district, after an income higher than $50,000, the tax rate or the tax bill as a percentage of income will be the same for everybody in that district. Okay, pretty simple. That's it. That's the way it would work. And the tax is paid to the state, not to the town. And it would be paid in installments, either through withholding or through set installment payment, so that it wouldn't be a one-shot lump sum bill that came at one time. The second chart is basically showing you the same chart that Paul showed you, which is lining up all of the people in the state and putting them into income categories. The income categories are across the bottom with an increment of $50,000 in each category. So it goes from less than 50,000 up to $1 million income. And then the height of the bar is showing you the percentage of income that's paid on your house site, your house and 2 acres. The red bar is current law. And so you can see, if you look at the pattern, it's pretty much the same as what Paul showed you for a different year, that the people paying the highest percentage of their income are actually up here, or between $100,000 and $150,000 in income. And then it drops down. And the reason there's a blip right here is just simply, this is actual data. So there's some people in that category, happen to be in that category, that are paying higher, but essentially this is the trend downward. And then if you went to age 388, it would be the purple bar. And so you would see that it's pretty much flat all the way across, as we showed in the earlier ones, meaning that the tax bill as a percentage of income would be the same for everybody as you go up. And then turning that into how the bills themselves would change. This is the same income categories and the same people. And it's showing you what in each income category, what the median tax bill would be. And so the red again is the current situation. And actually I should explain that when we're looking at the current situation, it's actually a two-step process. First, you pay the property tax and then you get an adjustment in the next year. Okay, so this is the net that you paid that you're looking at, the red bar. And then the purple bar is what you would pay under this new proposal. And we're calling it, even though it's based on income, we're calling it a resident education tax. And that's mainly because we don't want people to think that it is just part of the personal income tax. It is your education tax. Just the basis would be adjusted gross income, but we want to keep it separate from the income tax. So essentially what you see here is that at the low end, there isn't that much difference, but the residential education tax would get substantially higher as you went up in higher incomes. But then the question is, who is paying? Where are the changes? What share of our total residential education tax is being paid by different income categories? And so first, you have to look at where the taxpayers are now by income. So this is the income category across the bottom again. And then the share of households, the gray bar, the height of the bar is showing you the share of our households in different income categories. So you can see that actually 40% of the homeowning households are in the category between 50 and 100,000 income. And 95% of the homeowning households are below 250,000 in income. So even though the charts have shown you going all the way out here, and actually this last category of $1 million, if you were really continuing the 50,000 increments up until catching the last person, it would go way off the screen. But we lump them into anybody over $1 million in this category. But essentially 95% of us are in this category down here. And so if you want to then compare that with where the taxes are coming from, the gray bars again are showing you the same thing about where the households are in terms of their income category. And then the lines are showing you the percent of the total education taxes being raised on the homestead property, house site property, by each of those categories. So that what you can see is that the red line is current law, and then the blue line is where we would end up. It's not that much different, but it would lower the percentages paid by this category that was currently paying the highest percentage of their income, would lower that down and to this blue line here. And then you would see a jump in the higher incomes. All right, these would be the main differences. Another way though that I think that is a fairer way to look at where we would end up by shares who would pay for education tax is to look at it in terms of the share of income that we have, total share of adjusted gross income by these different categories. So you can see that you see somewhat the same pattern, that in terms of the total AGI, it's most of it is where we have the most filers, between 50 and 100,000. And you can also look at the purple line, which is showing you where we would end up in terms of the share of total education house site taxes raised. And you'd see that there's like a perfect match. It's a little bit low here because we've done a sort of a special decrease in the tax rate for households below 50,000. But over 50,000, there's a match between the percentage of AGI in that income category and the percentage of the residential education tax bill that would be paid by those people. And this is just showing you the difference in the same chart with current law. So current law was taking a much bigger bite in these categories and at the lower end. So that this would drop it, their share at the very low end, and it would drop it in this category here. And then it would be roughly the same. You can't really see the difference, but it would be higher in these categories. You can't see the difference just because there's so few people there. And then in the end, where it jumps up to raising 8.6% of our education tax, residential education tax on filers with incomes higher than $1 million, but they have 8.6% of the adjusted gross income. So essentially what we're doing is we're moving it so that it's exactly in keeping with where the adjusted gross income is. And those are the only charts I wanted to show you about the gist of it, but I think that the reason that the Tax Structure Commission wanted to go this way, the picture was, first of all, that it is simple and it's direct. And when we listened to all of the complaints that people had about education taxes, most of them, we had pages and pages, and we could sort of condense them and say that the complexity, the complications, the administration difficulty of the current system was not only getting in the way of it being effective, but it was getting in the way of anybody being able to understand it. So the second thing is that we had a principle that the taxes should reflect the ability to pay. And so we just wanted to clearly reflect the ability to pay. The third thing is that we think that this would change the way we're thinking about funding education. Right now, because of the double system that we have, people are still thinking that the right way to what your tax bill should be is based on your house value, and that when you get a credit based on income, it's a subsidy. And there's a focus on who's getting the subsidy and how much subsidy they're getting. And so this is sort of changing the discussion to say the fair tax, this is the fair tax. We're looking at what is a fair tax and not going through that two-step process of we tax you on one thing and offer a subsidy. And somebody asked at some point, well, is it inevitable that every 20 years or whatever, we throw out our old way of funding education and come up with a new system because it's not working? And I don't see that as the problem right now. I feel that what's inevitable is not so much that we throw out our education system, come up with another one. I actually think that the one we're dealing with ends up in a pretty good place. But I think what's inevitable is that we change our tax structure. We move towards moving our tax structure closer to the ability to pay. And that's really what we've been doing through the years. And we've been using income as the ability to pay. It would be great if we could also figure out a way to incorporate assets, but property, the value of your house isn't really an indication of your net worth or your ability to pay. So at this point, it's income. But I think that where we're going and where we have to continue to go is to move our tax structure so that it tracks the ability to pay. And that's not just for equity issues, but it's also because that's where the money is. And essentially, we have to be able to keep up with the ability to pay in order to fairly fund public services. So that's where we came out. That's it.
Thank you very much, Deb. And we do have some questions coming in the chat, but I think we'll hear from our last presenter, Don Tinney from Vermont NEA. Could you please introduce yourself, Don?
Sure. Thanks, Mari. I'm Don Tinney, a 31-year veteran high school English teacher from South Hero, Vermont, where the wind is really whipping today. So if I all of a sudden disappear, it's because the cable got in the way of the falling branches. But thank you. I really appreciate the explanations that we've heard so far. Both Paul and Deb have spoken to the complexity and the confusing nature of our tax policy in terms of funding education. And that's one of the reasons Vermont NEA has supported moving towards an income-based system, because it is confusing, because our citizen taxpayers don't really understand how their tax bill is generated. The other important part of this, beyond all the numbers, which are really important, but school boards work arduously every year to build a budget. It is definitely probably one of the most arduous tasks that they have. And I've sat through enough school board meetings to know just how hard they work, going through line by line to make sure that, that they are doing the right thing from the point of view of fiduciaries. But what happens as a result is that we end up with austere school budgets, because our school board members as citizens themselves will do whatever they can to avoid raising the local property tax rate in any way. And I understand that, but they will, have cut back or level funded programs simply to avoid raising the local property tax rate by a few cents. That has a direct impact on the experience of our students and our staff. And Tanya mentioned this before, and I know Tom Pear's here, he can speak to it as well from his experience at Winooski. But we end up with programs being cut because those budgets are so austere so that they'll pass. There's this, we have a great success rate in terms of passing budgets within Vermont. Upwards of 90% many years are passed, but those budgets being presented are really austere budgets. And what we're seeing today, and many of you on the call know this, an extreme personnel shortage in our schools. And there's a direct connection between the austerity with whether it's salaries or teaching supplies or broken down photocopiers. All of those things add up to negative working conditions, and folks say, I've had enough, I'm leaving, I'll go work somewhere else. So that's one of our concerns, is that it really has to be a simpler process and it has to be more fair, because really our taxation should be based on one's ability to pay. And with that, I will happily mute myself again and continue to listen, and happy to answer any questions as we move forward. Thanks again for being here.
Thank you, Don. So a few questions that have come in. One earlier question about the type of income. So the questioner wondered, for someone who has a lot of money, has a lot of property, but doesn't have a regular income, how would that be treated? And I think, Deb, we talked about that at the beginning. If you could just highlight how those folks would be included.
So it would be adjusted gross income, which is if you had property and there was absolutely no change, that would not show up. But if you had interest and dividends and a capital gain, all of those things would show up. It's not just your wage and salary income.
Thank you. And then Tina Cook brought up an important part of this recommendation in the bill about corporate income and the residential homestead piece of it and non-homestead. If one of you could go into more detail about that.
I guess I would say corporate income, if to the extent that it's passed through to residents, that would show up in the residents' AGI. Otherwise, corporations would pay the property tax on their property as non-residential property. So they pay an education tax on their property.
And Tina, did that answer your question?
Oops, I'm sorry. I'd like to see it based on their income or their revenues generated. Because, you know, I worked for Fortune 500, you know, we've got one campus and, you know, it's just not proportionate at all. So especially with banks too, you know, we're seeing banks reach into the state of Vermont that have no branches or, you know, have no investment here, and they're extracting wealth, but not, you know, contributing. So there's lots of money we should be collecting and not from the citizenry.
Mari, if I could just add one thing to this, I think it's a good point, Tina, that I think the legislature right now is actually looking at corporate tax structure and along the lines of what you're talking about. But as Deb said, most of the corporations that operate in Vermont are S corporations with pass-through income. The corporate tax pass-through income to personal so that it would show up in AGI. But the C corporations, which are the larger corporations that you're talking about, are the subject of this current conversation in the legislature. It's not a huge number, but there's a concern about particularly out-of-state corporations that have a nexus to Vermont, either with sales or income or property or whatever, that they pay a fair share to the states. And currently there's been a lot of sort of playing off of states and sort of trying to get out from paying taxes to states in any state by claiming, you know, by avoiding that nexus conversation. So that is a current conversation in the legislature, and that hopefully will improve the structure to do more along the lines of what you're talking about.
Yeah, that's great, because Vermont is definitely a target. You know, we see the Pandora Papers and, you know, and the Panama Papers, and we are a perfect target for those same bad actors. So, you know, we're overtaxed, period.
Thank you for bringing that up, Tina. I have a question, and then I'm gonna, if the people that are putting questions in the chat, if you're comfortable raising your hand and vocalizing them, that would be great. We haven't talked about rental, the situation with renters. Deb or Paul, you feel like taking that on? Explain how this works for people that are renting.
I guess the Tax Structure Commission felt that in looking at the big picture, there's no reason that we're funding education on homeowners and treating renters differently. And so that the tax on income for schools should apply to all residents. But we also didn't want to increase the taxes on renters. We wanted, if anything, to decrease the taxes on renters. So the idea would be to eventually, when we have enough data, figure out how to extend the education tax to renters, but how to give a renter credit to help rental households. Right now, we don't have enough information to figure out exactly how to do that. So the bill actually proposes an advisory committee to start gathering the data and figuring out a way to treat renters.
Yeah,
So at least
we're 75% of the rental population, BIPOC are, you know, we've got to solve that problem before any moves are made.
So for at least for the first year and possibly longer, the renters will not be included in this tax.
Right. So there would be no change in the way renters are affected until another bill, I guess.
We felt really strongly that renters should not be taxed twice, essentially, in
Yeah.
paying the income tax and then also paying in their rent the second homestead tax, which is why we really set up in this bill that advisory committee to really gather the information, as Deb said, so that we have a sense of how to credit renters for the part of their rent that is their landlord's property tax, while also bringing them into this system. And that transition, we don't know exactly what that will look like, because as Deb said, we just don't have the data because it's not how we currently are doing things. But we agree with you, Tina, that it was really important to not tax renters twice. And, renters are renting in many instances, not all, but many instances, because they are in lower income brackets and not able to buy. And so putting extra burden on them really was not the intent of this bill, which is why we excluded them for now.
And I think it would be
Also,
really important to have in the advisory committee to have representation from the BIPOC community.
Yes, also because in Vermont, it is legal to have, sublet, sublease. And then that means the renter does not get to take advantage of the tax credit. What is that? The homestead credit?
For the renter rebate, I think is
Yes, ma'am. Yes, thank you.
Yeah. And to Representative Cortes's point, we when we were developing that advisory committee, we did include, I believe, because I remember recommending it, an appointee by the Director of Racial Equity, really making sure we bring that voice into this conversation, really looking at the disparate impact of tax policy and of incomes, really is what we're talking about.
Paul Forlenza, you asked a question. You want to bring that out now?
Sure. I was just curious. Seems to me there are two adjusted incomes. One is the federal adjusted income, and then right now in Vermont, we add or subtract a whole bunch of things to that, and I call it the Vermont adjusted income. This proposal is based on which one of those? Deb, you're muted now.
I'm sorry.
Right.
Maybe I just muted myself instead of unmuting. It's based on the federal AGI.
It's based on the federal. Okay.
Yes.
So that's different than the way it currently is. Is that right?
Right now, as Paul said, you have to have 22 pieces of information. Right now, and actually this is an important difference, but you have to add all these things into your income to come up with household income. And the income categories I used were household income because that's what we're familiar with now. But in reality, at the low end, you're adding in a lot of things like unemployment benefits. You're even supposed to add in cash gifts. You add in any welfare payments that you got. So if you went to AGI, it would be much less. It's one of the reasons that a lot of the lower income households would be paying less under this definition.
It's a good move. Thank you. Glad you guys are doing it that way.
Jim Byers.
Well, actually, my main question was kind of answered with the renters are going to be excluded at first, because I was wondering what the enforcement structure was going to look like. But if we're using the federal AGI, because I was also wondering about the increased burden on state employees, auditors trying to figure out, especially with higher income, what's income, what's dividend income, how they're going to sort all that out.
Thanks, Jim. Elizabeth.
I'm just thinking about local government, because we've had so many conversations about that in the district, and it's about how our spending at one school affects the cost of education in the next district.
So Elizabeth, it's a little bit hard to hear you, so I'm going to read your post in the chat. And your question was, would this mean the stakeholders of each individual school budget are actually statewide taxpayers, local vote, but statewide funding? Who should be approving the budget? Is this a disconnect from local governance control over spending when it's not truly local spending? Are we not spending enough, or is it a prioritizing issue? And where does that pressure to spend responsibly come from?
I can take a stab at that, which is that the tax base, as I said, is a state tax base, but your local school vote on spending determines how much the taxpayers in your district are going to contribute. So if you want to spend more per pupil, the tax rate will go up and everybody in your district will be spending more. So that is the connection between the budget, the cost control, the budget, and your tax rate go up together.
Yeah, and what I would add is that aspect of H388 is really not a change from the current, what we've been doing for 25 years in Vermont. That essentially we're using a statewide tax base, but there's each individual town or district has sets its own tax rate based on spending per pupil. The one variable is spending per pupil that impacts the difference in tax rate from town to town. So and we did that to preserve local control, to leave in place the ability of a community voters to decide how much they want to spend or need to spend for their school.
Thank you, Deb and Paul. And you're reminding me that your presentation, Paul, earlier brought some of this up, and I wonder if there's a way that you could share, you and Deb, your slides with us. You can send them to me and people can ask for them, or if it's easy enough to drop them in the link, that would be great. Okay, we have I think that's it for the questions. Anyone else have a question that I didn't notice, or something else you want to add?
I do have a question about computer infrastructure. I see this possibly being an increased burden on computing power, and I'm thinking back to the debacle we had when with the pandemic, when we were switching everything over like a DMV, and with unemployment benefits and everything like that, how everything crashed. Is our current tax computer system up to the challenge of having increased data thrown at it? Or is this going to be another expense that would have to be addressed?
I'll say something, and maybe Deb has something else she wants to say, but first of all, I don't know that our current computer system is actually, I keep hearing issues, and I think legislators can speak to this. The tax department is always talking about how their existing capability doesn't allow them to do the things that they need to do now already, so the question of, is there a need to upgrade? The answer is probably yes, independent of this legislation, that there's a need to upgrade. I don't know that this, there is some back office work that would need to happen, but honestly, it's different than what they do now, but it's not a whole lot different. In other words, an example I would use is that the bill provides for the tax department to send out a notice of what your tax would be in July or, summer each year. Currently, they send out a notice of what your Act 60 or what your, your school tax, reduction amount would be that you file with your taxes. So they're filing a piece of paper to each taxpayer, but there's different information on the piece of paper. So like I said, I think that the state, throughout state government, there's a need to upgrade. I don't know that this creates a problem that makes that, harder to do.
I would just add to that yes, it would be different, but in a sense, it's removing. Right now, there's that back and forth where you filed for your credit with the tax department. They have to go through those 20 pieces of information and give it to you or not, but they don't give it to you. They give it to the town clerk. And so then they shift that part to the town clerk. So there's that coordination. And that theoretically happens before July 1st, but then there's a late filing deadline of October. So then things get changed in October. So it's happening not just at the tax department, but also at the town. And the other issue that it avoids in that connection is that now at the town level, people can figure out if they know what your credit is, they can back into your income. So in a sense, we've always said income information shouldn't be at the town level, but it sort of is now. So it would just keep that in the tax department and avoid that, and avoid the computer problem that you're causing in other places too.
From the
Thank you.
standpoint of just infrastructure, what COVID showed us and what I think many of us already knew is that most of our computer systems across state government need to be upgraded, need to be improved. And I don't think this one's any different. But, I think it's sort of separate from this issue is really what we're hearing.
Tom Payor, you had your hand up a little bit ago. Did you still have a question?
Yeah, and thanks for holding this. I had the pleasure of working as an intern with Paul about 12 years ago, and 12 years later, I'm still trying to figure out how exactly Homestead rates work. Some days I get it, some days I don't. So this feels like a much simpler approach, and it does make things a lot easier to understand in terms of where is my money going and why. That was pretty astute about the idea of it being a subsidy, the house credit. Too often that's how I find myself thinking about it as well. And I think just having simplicity and understanding how we're being taxed is going to help the conversations that happen at school boards when we are talking about how we want to invest in education locally. I'm interested to know, like, what are some of the arguments or possibly a major argument that might get in the way of this work moving forward, because I think this is the right work to do. So what is it about a homestead rate versus an income rate that's so compelling to, a certain group of taxpayers?
I'll just go back to my Howard Dean comment. I think Governor Dean sort of summed up the obstacles. The two primary obstacles are the perception that income is more volatile, and that what Howard said in that Brave Little State piece that came out yesterday was that if you hit a recession, then all of a sudden rates go flying through the roof. And as I showed you in the chart in the slide, which Amari, I will send you those slides so that you can make them available.
Thank you.
So that essentially property and income when you look over time really have about the same level of volatility, and that the commission found the same they found that to be true as well. The other is that rich people will leave the state if you tax them like this, and as I said earlier, there have been a number of studies, not that we've done, but that have been studies in other states where they've actually done these aggressive taxes on upper income people. But we also don't see in Vermont data evidence of big shifts as a result of tax changes, but we haven't had big tax changes in Vermont. So it's hard to use Vermont as an example. But for the most part, all these studies say the same thing, which is that people don't move from state to state based on taxes. It's not that no one does. You probably know I know people that have done that. But the point is, it's not thousands or hundreds of thousands. It's not enough to actually make the taxes, to skew the tax system. It's really on the margins, and very, very few people actually make those kind of moves. So those two things, we've learned a lot since 1997 on those two topics, and they really are not the obstacles that everybody thought they were in 1997. So I think really now it's just a question of inertia. Can we overcome the inertia of doing what we always have done and have done for centuries, since the founding of the state, which is to tie school taxes to property values. And as Deb pointed out, things were a little different in the 18th century and the 19th century in Vermont. So I think it's really a matter of, like any major change like this, to overcome the perceptions that, but there really isn't any sort of reality that makes this unworkable. That it absolutely is workable.
Yeah,
And it's also frustrating too, it's a bit like a red herring in that what we're trying to do here is to make ed funding more equitable and provide some relief for lower income people and elders and folks that have property that's been generational property like farms. So what we really want to focus on those folks in our community, and that's who we're really concerned about in this bill. I know Coco, Tanya, I think you have something else to add, and then I'd like to get to Coco Mosley.
Yeah, absolutely. One of the things I wanted to add to this is that change is hard. And I think there is a lot of misperception and sort of rhetoric around what it would mean to change the tax structure and who it would impact. And it really I think about education and about all of us educating our friends and our peers and our neighbors around what this would really mean. Because I think a lot of times what I hear when I'm out talking about this is, well, I already pay a lot in taxes. And for the most part, the people I'm talking to are in that bracket that either wouldn't see much of a change or would see a lowering of their taxes. And so I think a lot of it too is just about helping people understand the individual impact on the vast majority of Vermonters. And that would not be paying more taxes. But I think so frequently the way we talk about taxes is sort of like, oh, those are a bad thing. We don't want to have those. We already pay a lot of those. And as Tina pointed out, there's a big chunk of Vermonters that really are overtaxed because people aren't all paying their fair share. And so really changing the conversation and educating our friends and families, I think is the biggest thing we can do to overcome these barriers of perception.
And on that issue of spreading the word and educating friends and family, I will be following up with an email with all sorts of links and information, including a link to the cloud recording so you can share with folks. Coco.
Thanks, Maury, and thanks everybody for this really informative and very detailed presentation. It's so complex. I look forward to the one pager. And my question really is kind of piggybacks a little bit off of Tom's, and I'm curious what what the legislative appetite is for making this kind of change to our tax structure, and if there's a conversation at the Vermont State Board of Education, what's the other conversation happening in regards to making these changes, and where do you see this kind of going over the next few years?
That's a great question, Coco. And this topic has been something discussed over quite a number of years, but I think is also active now. Deb, you've been testifying in House Ways and Means, correct? I don't know if either you or Representative Elder would want to touch on those conversations.
I'd like to hear from the legislators about how they think it's moving. All I do is
Sure.
testify.
I'm happy to weigh in on that. Hi, Coco. Nice to see you. Yeah, so I think there's a lot of appetite for this concept. As has been mentioned, high property taxes are unpopular broadly. So we can all think of folks in our communities who may own a family house, or they may own a home that they purchased for 1/10 of what it's worth, and due to a fixed income, it's not possible to pay the full boat on the taxes, and so then they're put into this rather complex system. And some people just don't even understand that there is a income sensitivity. I've worked with constituents who were not taking advantage of programs that they were eligible for. That kind of thing wouldn't be possible under this. So I think that so many of us in the legislature have that kind of constituent experience, working with a constituent with that experience. And so, yeah, I think there's broad support for this concept. We have heard about it in the context of other education finance reform work we're doing that I'm not going to get into the weeds of, but I think for me, this issue belongs very much side by side with that issue. As soon as we heard the report of the Tax Structure Commission, I think a lot of us are really keen to have a bill like H388, but at the same time, I think what I see as a real pathway for the bill is to have this idea moving alongside another issue with real momentum, like education finance reform. And I think that there are some elements that could lead to a strong, basically a strong coalition for that package of reforms and changes. Because again, this is a big lift. It's been tried before. It's been the status quo for a long time. But I think there's a lot of reason to be optimistic about the legislative path forward for this concept. I don't know if it's going to be H388 being taken off the wall and worked through the process in this biennium. I'd say at this point that's unlikely, just given where we are. However, do the concepts contained in there, which really came from the Tax Structure Commission report, move forward? I'm hopeful that the answer to that is yes, at least on the House side, and fingers crossed. If not, the topic has momentum going into the next biennium. But I haven't given up on this year yet for at least seeing a real step towards this. I think it's an idea, frankly, whose moment has come.
Like many policies that come from the State House that make significant changes, it's often a multi-year process, and presentations, forums, discussions like this are part of that to help lift the conversation in our communities and help people understand more, get more comfortable with it, have more conversations with their legislators. And I will say that there is tripartisan interest and more, including the independent legislators in this concept.
Mari, if I could just make a comment here, I think that it's a big step that H388 exists, that it's actually been drafted and introduced. Public Assets has been wanting to see a bill like this introduced in the legislature for at least a decade. It was a big help that the Tax Commission dug into this issue and came out with really really thorough analysis and a conclusion that this is the way to go. So I just want to point out that this is progress, even though it's not passage at this point, but it's a huge step. These two things that happened in 2021, the bill, the tax structure, the Tax Commission's recommendation, and the bill introduction. So I just want to appreciate that's a big step. And now there's a Senate bill, S212, that is very similar to H388 as well. So that's, I think all of the above in terms of what it takes to actually move this to the next step. But I also think we need to sort of appreciate the progress that's been made just in the last couple of years.
I think we're finished with our questions and discussion. Any other issues someone wants to bring up? Thank you, all of you, for attending and contributing to the discussion and committing to bringing this out to our communities and helping us move this forward. And thank you so much, Paul Cillo from Public Assets Institute and Deb Brighton from the Vermont Tax Structure Commission and Don Tinney from Vermont NEA, as well as my amazing colleagues, Representative Caleb Elder and Tanya Vyhovsky. And as I said, I have all of your emails and I will forward to you everything that I can get, including someone wanted to know what the list of 20 was. So I'll try to get that. Maybe Paul, you have that at hand, or Deb. Thank you, everyone.
All right. Thank you.
Thank you.
All right.
Bye-bye.